Britt Burner from Burner Prudenti Law. We always love having her and are always super grateful for all the wonderful programs they do for us. And I will just give our webinar right over to Britt to start our event off. Thank you so much
Great.
for joining us.
Thank you. Thank you so much for having me. Thank you everyone for joining us today. So my name is Britt Burner. I am the managing partner of Burner Prudenti Law. We are in our 30th year, which is really exciting. And we have been representing clients for 30 years, from Manhattan all the way out to Montauk Shelter Island. So nearest to Shelter Island, we have an office in East Hampton, West Hampton Beach, and then we also have East Setauket and Manhattan. So happy to come to you today and talk about some estate planning ideas and topics. So I'm just going to jump right in. So we're really going to talk today about planning with trusts. So I'm going to leave out conversation about healthcare proxies, living wills, powers of attorney. While those are incredibly important documents, they're just not the subject of today. So please learn about those, tune into a different webinar, or go to our website to get more information on those topics. But jumping right in to talk about trusts, I think it's important to start with a conversation about what a will is, what probate is, and then that gets us to how to avoid probate, one of those ways being creating a trust. So a probate of a will is an important topic to discuss because most people don't realize that if you have a will, that in order for it to be legally binding and your wishes to be followed, it must go through a court process called probate. So probate needs wills and wills need probate. You can't have one without the other. So when somebody dies, if they have assets in their sole name with no beneficiary, then their will be followed after this probate process. So take, for example, somebody who has assets that are joint with their spouse, their property is joint, their cash is joint, their investments are joint. Perhaps they have retirement accounts, they name their spouse as beneficiary. Well, when that first spouse dies, there may be no probate of the will because everything will go to the surviving spouse, either as joint owner or as beneficiary. So that will only be followed now when the second person dies, if they never did anything to put additional beneficiaries on or anything like that. The will of the second spouse will go through probate because now that surviving spouse has cash in just their name, property in just their name, investments in just their name. And so all of that will go through the probate of the will. It's also important to note that not all assets will have to go through probate. So, for example, if somebody has a joint owner on their home and a beneficiary on their retirement account, but their cash has, $150,000, say, of cash, and it has no beneficiary or joint owner listed, the will go through the process of probate for the purpose of that one bank account only. So probate needs wills, wills need probate. If somebody dies without any planning, without a will, and with assets in just their name, without beneficiary designations or a joint owner, then there's a process called administration. And eventually your assets will pass on to who New York State determines to be your legal next of kin. This is important because those legal next of kin who would take your assets if you didn't have any planning are the same people that are required to notice that probate is being completed on your estate. So part of the probate process is notification of your legal next of kin that your will is going to probate. They receive a copy of that will and they have an opportunity to contest it. So when we start to talk about avoiding probate and why we might want to avoid probate, these next of kin, these heirs, might be the reasons number 1 and 2, right? So if we don't know who they are. So for example, I have a client who is a single person, never married, no children, their parents are deceased, they were an only child. So presumably their next of kin are maybe some cousins because, their aunts and uncles are deceased, or maybe even a farther afield related family member, that person, when looking at planning their estate, would see that probate of their will would require identification of these people and notification to them, and they might not have any clue who they are. And so for efficiency purposes, you may not want to have your estate rely on this probate process. So when we don't know our next of kin, we like to avoid probate. We also like to avoid probate if we don't like our next of kin and we're not giving them anything. So for example, I may have very easily identifiable next of kin. I may have 2 children, but I might be leaving all of my assets to one and nothing to the other, or the bulk of the assets to one and a little bit to the other. In that case, I may want to avoid probate because the child that I'm leaving out is going to get a copy of my will. They're going to see that their name is not included, or it's included to say they don't get anything. And they'll be sent a letter, we call it a citation, and it says, and come to court on this day at this time and complain, essentially, right? And come to court and post your objections. And so a lot of people like to avoid probate when they are disinheriting one of these next of kin, because they don't want a situation where the child who's supposed to receive everything ends up spending a lot of legal fees just to make that other child go away. So when we don't like or know those next of kin, we like to avoid probate. We also like to avoid probate if you have disabled or minor beneficiaries, because if the court sees them as unable to represent their own interests in the probate of your estate, then the court will appoint what we call a guardian ad litem, an attorney, to represent the interests of the minor or the disabled person. And they have to do a report, and that can be costly and take extra time. We also like to avoid probate if you own property in multiple states. So we very commonly have a client who lives in New York, it's their primary residence, but then they also own property somewhere warm, maybe Florida, maybe Arizona. Well, if they own their assets in New York in their own name and they own this property out of state in their own name, well, then upon their death, we would have to do an initial probate here in New York because it was their primary residence, and then what we call an ancillary probate in each state in which they own these other properties. So if somebody is a skier and likes the warm weather, well, they might own in Florida and in Vermont. And then we could end up in a situation where we're probating in 3 states. So when you own property in multiple states, we often like to avoid probate by creating trusts. The ways we avoid probate, so I've said a few of them already, right? We can name joint owners, we can name beneficiaries, and we can create a trust. Now, a trust, just like a will, is a legal document. But the difference is that this trust, and it could be a living trust, there's a lot of names that it could be used, but it creates a legal entity while you are still alive, and then you give things to it. So if you're transferring that Arizona property to the trust, you actually sign a deed that says the owner of the trust, the owner of the property is the Britt Burner Trust, right? I am giving my property to my trust. So you have to create the trust and then you fund it. And then remember, if probate is for assets in your sole name with no beneficiary, if it's in the name of your trust, it's not your sole name. And so now we've avoided probate on those assets. So those are the reasons we avoid probate, and the quick answers as to why how we might avoid probate. One last reason that I like to avoid probate is if there is a taxable estate. The reason is because when someone has a taxable estate, we're on a relatively short time frame to determine what the assets of the estate are, get the appraisals, get the values of everything, file the tax returns, and then make good on the taxes if taxes are owed. So if there's a taxable estate, I often don't like the estate to be held up in the process of probate in any way, because taxes are due 9 months from date of death. And the fact that an executor hasn't been appointed yet because probate is not complete is not going to get you out of that tax deadline. So if it's a taxable estate, we often like to avoid probate. So what does it mean to have a taxable estate? In New York in 2025, as if someone dies this year and they have less than $7.16 million to their name, they do not have a taxable estate. Over that, they do. Under that, they don't. So taxable estate, this includes everything. This includes death benefit of life insurance. This includes retirement accounts. It doesn't matter if it has a beneficiary designated. It doesn't matter who it goes to. We add up everything that's yours at the time of your death, and that's what goes into determining your gross taxable estate to see if you've hit that limit or gone over it or not. There's a few things about that New York estate tax that I want to point out. One is it's use it or lose it. So let's say we have two individuals, they're married, and they together, when you add it all up, have $8 million. Well, when the first person dies, if everything is in joint names, as I described earlier, and has the spouse as the beneficiary, then when spouse one dies, all the assets belong to spouse two. Now, when spouse two dies, if they have an 8 million or more, if it's grown dollar estate, they will have a taxable estate. Estate taxes will be owed because the survivor is over the 7.16 million. However, if we take advantage of that first person's exemption, and that's some of the trust planning we're going to talk about today, we actually create a situation where we've doubled the exemption because we can use the first spouse and the second spouse. So between the two of them, and it obviously depends what year they die, but you're looking at over 14 million of exemption if you plan properly. So it's a really important thing to know that New York is use it or lose it. It's also important to know in New York that we have a cliff. So what that means is there's no tax all the way up to the 7.16. And then when we hit 105% of that number, so somewhere around 7.5 million, we fall off the cliff and we're taxed from $1. We are not only taxed on the overage, we're taxed on the entire estate. Now, this is still often a smaller tax than the federal because it is a lower percentage. At that 105%, it's about a 9% tax, and it goes up to 16%. That's the highest tax rate for estate taxes in New York. But it is on the entire estate. So you could see how you could very quickly go from $0 tax to almost $1 million in tax just by the fact that you've fallen off of that cliff. So it's an important number to pay attention to. There's also no gift tax in New York. So if I give away $10 million and I live for 3 years after I give that gift, it's never counted for New York purposes as part of my estate. I'm never going to pay taxes on that. However, if I give away 10 million and I die within 3 years, so in less than 3 years after I give that gift, then for the purpose of calculating how much tax is owed on my estate, they're going to take everything I own when I die and add back in that 10 million to see what taxes are owed. So when you are doing gifting in New York, you have to be mindful of this 3-year rule. Different than New York is the federal. So the federal estate tax rules are different. So first of all, the exemption's higher. This year it's 13.99 million. This is based on an increase that was put into the 2017 Tax Cut and Jobs Act when Donald Trump was president for the first time. And depending on what happens at the balance of this year, that law stated that at the end of 2025, the amount would sunset. So it used to be 5 million index for inflation. That 2017 law made it 10 million index for inflation with a sunset, which would mean that at the end of this year, it would go back to 5 million index for inflation. However, most people believe that due to the current, who is currently in power, we have the same president again, that it will likely get extended. So that's a wait and see, but likely to be extended to the 10 million index for inflation. So this year we have a $13.99 million exemption. That is also per person, which would mean for a married couple, you're looking at about 28 million. There is portability. So it is not use it or lose it. If spouse one dies and everything goes right over to spouse two, If, especially if, and not especially, but spouse two needs to have filed an estate tax return when spouse one dies, saying, I want to save that exemption for later. They file for portability. Then when the second spouse dies, the estate has that spouse's exemption plus whatever the first spouse didn't use. So it could be well over 28 million at that point. So filing for portability when the first spouse dies is important. We are taxed on the overage, but we're taxed at 40%. So it's a much higher tax, even though the exemption's higher and some parts of the federal might seem better, it's still a very high percentage of tax. And again, still the largest tax we're concerned about. If you have a New York taxable estate and a federal taxable estate, you get credit against your federal estate for having paid estate taxes on the state level. So it's not just a straight 40% plus the 9% or 16%. It is it takes into account the fact that you paid those taxes. Gift tax wise in the federal scheme, we have a $19,000 annual exclusion. So I could give $19,000 to everybody that I know and not have to file a gift tax return and never pay a tax on it. But as soon as I give more than 19,000 per person in a given year, I need to file a gift tax return, and that is a placeholder against my lifetime exemption. So if my lifetime exemption is going to continue to be 14 million plus, and I only have $1 million to my name, then I'm never going to have a tax. So that 19,000 tends to be a bit of a red herring. Because even if you add up all those incremental gifts, even if they are over 19,000, they will never exceed your 14 million lifetime exemption. So that's the last reason as to why I like to avoid probate is if there's a taxable estate. So what are we going to do about it? So for the first reasons that I described, in a lot of those cases, it might be appropriate to do beneficiary designations and joint ownership. But once we start to get into a taxable estate or a disabled or a minor beneficiary, we're often talking about trusts that continue on beyond your death, in which case we don't like to create those through the probate of a will, because that will continue to be under the court's guidance. And therefore, anytime there's a change, like a change of trustee or something like that, you have to go back to the court and apply for the change. And so it's a lot of bureaucracy that might be unnecessary in a certain circumstance. So what we often do, if all we're doing is looking to avoid probate, is create a revocable trust. So I will talk in a little bit about irrevocable trusts for Medicaid planning, but for the purpose of avoiding probate only, we like to do revocable trusts. You might have heard about a living trust or a revocable living trust. These are all different ways of saying the same thing. You will be in charge of it for your lifetime. You can be your own trustee. Your spouse could be co-trustee, or your child, anyone you want, if you don't want to do it on your own. It will hold your own social security number. So you don't have to worry about an additional tax ID number or filing additional taxes. It all gets filed with your same taxes as it always did. A revocable trust, again, you're fully in control of it. So you can use every dime if you want. You can change who it goes to at your death. You are not restricted in any manner. However, when you die, all the assets that have been titled in the name of the trust will pass according to the terms of the trust. So for example, if we do have a spouse and we are worried that the combined estate will be over that $7.16 million mark, we create what's called a bypass trust. You might have also heard of this called a credit shelter trust. We also, in our office, often call it a family trust. This is a trust that captures that estate tax exemption of the first spouse to die and does not take advantage of that full marital deduction, right? Because if I leave everything to my spouse, it could be $300 million and my spouse is not going to pay a tax on it because there's a full marital deduction. The issue is going to be at the second death when my spouse subsequently dies, there will be a tax owed because we didn't use any of my exemption. And obviously at 300 million, there'll be quite a tax owed. So when we do these bypass trusts, we can either force it to the bypass trust. So my trust could say automatically put everything in the bypass trust. That's the end of it. Or we can allow for the spouse to have what's called a disclaimer. So the spouse at the time of death can look at what the tax laws are, look at what the asset values are, look at the asset classes, look at their own needs and health, and say, you know what? I'm going to disclaim this amount, which in theory means I'm not going to take that. It's going to go to the bypass trust, and therefore it's not taxed at the second death. Now, the surviving spouse can still use it if they need to. And depending on how the document's written, sometimes it says the spouse and children are beneficiaries. Sometimes it says just the spouse. But again, it utilizes the estate tax exemption of the first spouse to die. The other type of disclaimer we often put is, let's say we have someone who's not a married person and they're worried that they will be over the 7.16 million. We can put in what's called a Santa clause. And the way that usually works is with the same thing, a disclaimer, and any disclaimer has to be made within 9 months of date of death. And so the beneficiaries, your nieces, nephews, whomever it could be, might say, you know what? This is at 7.7 million. We've fallen off that cliff. I need to give some of this away to charity in order to get back under and not have to pay a big tax. So if your documents include this Santa Claus, this disclaimer to charity, then your beneficiaries you've chosen the charities in advance, and all your beneficiaries have to say is give X dollars to the charities that are listed here, and the balance will go to the beneficiaries. And now we've gotten rid of the estate tax. Again, that's a disclaimer, just like with the bypass trust for the spouse, and that has to be decided upon and papers filed with the court within 9 months of date of death. The other type of trust that we often create within your revocable trust is what we call a descendants trust, is a trust for the benefit of your descendants. If they are not your lineal descendants, meaning you didn't birth them or birth their parents, then you can call it a beneficiary trust. It's just a title, with the idea being that those that you've left assets to receive those assets in a trust that has creditor protection. It's outside of the taxable estate of the beneficiary. So if they're wealthy, this is not going to add to their estate tax. And they can, if you want, end up being their own trustee with certain limitations. And there can be a lot of flexibility built in, but it's this idea that we can build protection for those we're leaving assets behind to. Before I move on, I'm going to move into Medicaid irrevocable trust. I just want to pause there and see if there's any questions regarding revocable trusts, probate, or taxes, anything that we've covered thus far. And I'll just give it a minute.
All right, we have some hands. Okay. Lenny, you should be able to ask your question.
Okay, I think it was regarding the ancillary. Hi, first of all, the ancillary dimension of having property in two states. How is that handled? Or so New York and Florida in this particular case.
Sure, yeah, very commonly. So if you own, let's say you own a condo in Florida and you live in New York, it's your primary residence. Your will would go through probate in New York first, and then there would be an ancillary probate proceeding in Florida. It can be complicated because one, if there's a delay, right, and then nobody's responsible for your condo during that time period in Florida while it's sitting in probate. So what a lot of people will do is they will create one of these revocable trusts and then sign a deed transferring the ownership of both their New York residence as well as their Florida residence into the trust. So the trust will be the owner and it will avoid that court proceeding in both states.
So there's obviously other reasons to have a trust other than avoiding Medicaid clawback.
Correct. So I haven't gotten to the Medicaid part yet. I'm going to move
Yeah.
on to that next. So yeah,
Well, I guess my
everything.
question is just, you know, what are the other reasons that one needs to bother with a trust if you're not protecting it from Medicaid? I mean, or, you know, does that make any sense?
Sure.
Trying to,
Yep.
yeah.
So to avoid this probate proceeding in 2 states is one reason. So all those reasons I gave about avoiding probates, I'll say those without
Okay, yeah, you know,
having those.
but if you have an IRL, if you have a RLT and you die, it becomes an IRLT when you die because you died.
Correct.
Okay, so what's the point of having an RLT?
So one is to avoid the court, to avoid probate.
Okay,
Another is to make it easier to administer ongoing trusts if you have these ongoing trusts for your beneficiaries. And then, I mean, those are the main reasons.
okay. And that ancillary, is that something you just put in your will, that ancillary property that you own? If you put it in your will specifically that it's, you know, I have it as a percentage, so with my siblings. So we each have children. And each of us would be, you know, passing our properties on to our children. That would just be designated in our wills.
So yeah, your will can say exactly what you want to happen, whether you want to say everything that I have split equally to my kids, or you might say give this property, this one, this property, that one. That's the terms of the will. That's fine. But regardless of what the will says, if you own property in multiple states, it will have to go through those multiple court processes in order for
Right.
those assets to
Right.
pass on.
Mm-hmm.
Mhm.
Okay. Thank you.
Yeah, thank you.
Right, thank you. And I think we have some questions in the chat. Let's see. Okay, so Vivian asks, believe it's a question on auditing. Um, let's see. You're
Let's go to this.
yeah,
That first question, maybe you could, the first comment, maybe Vivian could clarify.
sure.
Because I'm
Um,
not sure.
yeah. Okay,
Yeah.
so Regina asks, what about the reverse? If you have your primary residence and trust set in California but own property in New York?
Yeah, so technically your estate planning is done in the state in which you are a primary resident. So if you're a California resident, you just own New York property, you can talk to your attorney in California about doing a deed to add your New York property to that California trust. And so you could do a deed transfer so that your trust owns your property in New York, and then you can have your trust determine how that's distributed at your death. Yeah, so okay, so then there's a comment here about revocable trust becoming irrevocable, and I know Eleni said it as well. So yeah, so I haven't talked about irrevocable trust yet, but I'll talk about a revocable trust, which we've covered, which is, so if you have a revocable trust, it has your social security number, you're the trustee, you can change it, you can do anything you want. Your death does make it irrevocable because the only person who can revoke a revocable trust is the creator. So if you're deceased, you can't revoke it anymore. Also, you can't use your social security number anymore because you can't use the social security number of a deceased person. So upon your death, your revocable trust becomes irrevocable. The terms of it are set except for to the extent that you've allowed beneficiaries to maybe identify subsequent beneficiaries or something like that. But the terms of it will be set and it becomes irrevocable and gets a new tax ID number. That is correct. Okay, I think we're done with questions on those.
Yep, I think those are the questions we have so far.
Great. Okay. So now I'm going to talk about irrevocable trust. So as a broader topic, before I dig down into the Medicaid portion of it, as a broader topic, an irrevocable trust that you create while you are alive is a trust in which you give something up in order to gain something. So that's the general answer. The other way to describe an irrevocable trust is it's not revocable, but that's not so helpful. So I always think you're giving something up in order to gain some kind of a protection. So for example, we often create irrevocable trusts when we're trying to get things out of your taxable estate. So an irrevocable life insurance trust is a great way to describe it. So take that person who has their house, they've got some cash, they've got some investments. Let's say it all equals $6.5 million. So they're not over that 7.16. They don't have a taxable estate. But what if they have a $2 million life insurance policy? Now, when they die, the 6.5, we add the 2 for the life insurance policy, and now they have an $8.5 million estate. And now it's taxable. So very often people will take that life insurance policy and move it, retitle the owner to be an irrevocable life insurance trust. So if it's my life insurance trust, it's my policy. I can't be the trustee of that trust. Someone else has to be, with the idea being that once that policy is in that trust, and if it's an existing policy, I have a 3-year wait period, then when I die, that 2 million death benefit does not count towards my taxable estate. And so the benefit I'm getting is that I'm not going to have that be part of my taxable estate. But what I'm giving up is control over that life insurance policy. Now, I might not care, right? The whole purpose of the life insurance is for it to sit there, and then when I die, to go to my kids. Maybe that's my reasoning for having it. So if I have to give up control over the policy, it doesn't really matter. Whereas other people, that might be a bigger deal because their financial plan might involve them using the cash in the cash value of the policy. And then if they lose the access to that cash value, that could harm their financial plan. So it's not going to work for everybody the same way, but that's an example of a life insurance trust and how you're giving something up in order to get a benefit. And that's the irrevocable trust. Now, in New York State, an irrevocable trust can be revoked if the creator and the beneficiaries agree. So if I create this life insurance trust, but in the end, I decide I want to get the policy back out and put it in my name, if my beneficiaries aren't minors and they sign off and agree, we could revoke the trust. So there are options you're not necessarily stuck in. But when you start to talk about the irrevocable trust for Medicaid asset protection, we can make it even more flexible. So I try not to focus on the word irrevocable when we talk about these trusts because we have a lot of flexibility built into it. So for example, when you create an irrevocable Medicaid asset protection trust, and let's say you transfer your house into that trust, you cannot be the trustee and your spouse cannot be the trustee. Let's say you have 2 children and you name them as the co-trustees, and one of them starts to go rogue. They have a bad, boyfriend, girlfriend, a bad marriage, and you're getting nervous that they're saying some weird things and you're not sure that they're going to do what you want them to do with the assets of the trust. You can keep the right to change the trustees. You can also keep the right to change the beneficiaries. So if that one child's going rogue, you say, listen, if you go rogue, I'm going to remove you as trustee and I'm going to take you out as a beneficiary. I'm going to lessen your share. I'm going to take away your share. And so in some ways, even though you're not controlling the day-to-day of the trust or the assets within the trust, you do keep control with those strings on the trustees. We also have a trust where you can, in the Medicaid trust, where you receive all the income. So let's say you have a rental property that's in the trust. You could receive the net income after expenses and taxes. If you have investments in the trust, like stocks, bonds, etc., you can receive any interest or dividends on those assets. So it's not that the assets are completely locked up. The main part of when I go back to this concept of what are you giving away and what are you getting, is you're giving away control because you can't be the trustee, and you're giving away the ability to access principal. You need to name others can be beneficiaries of principal. So for example, your children could be beneficiaries of principal and receive assets of the trust, but you can't receive assets from the trust. Your spouse can't receive assets from the trust. And the document needs to say that the trust funds cannot be used to or for your benefit. Can't be given to you or used for your benefit. So for example, the trust assets can't pay your rent. That's not allowed. Now, if the trust owns your home, you can have the exclusive right to occupy in the home. You're responsible for the maintenance and the upkeep and the taxes, etc., of the home and the utilities, just as you always were, but you can't receive principal. So if that home is sold, you can't just take the money out. The trust says you're not allowed to have it. And that's what you're giving up. And what you're getting in return is Medicaid asset protection. So you're saying, if I apply for services in the future, either home care or nursing home care services, or my spouse, then the Medicaid program will not count the assets of the trust as my assets when determining my financial eligibility. Now, for nursing home care in New York State, we have a 5-year look back. So what that means is that if you create the trust now and then 5 years goes by, at any point after that 5 years, if you were to need nursing home care, they would not penalize you for having put assets into this trust. Because when you apply for Medicaid, they say, are you eligible now? Yes or no. And then they go backwards and they say, over the last 5 years, now you don't have to have been eligible those whole 5 years, but they're looking to see if you gave anything away over those 5 years. So if I get to 5 years and 1 month, and then I apply for nursing home care, when they go back the 5 years, they will not see that any assets were transferred out of my name. Now, you'll tell them that you have this trust and that the house is in the trust and it's full transparency, but there cannot be a penalty assessed by the Medicaid program because it was more than 5 years before. Now, for home care in New York, currently we have no look back for home care Medicaid. That means we can transfer assets and apply for Medicaid to pay for care services at home the following month. Two things to point out with that. One is that in April of 2020, there was a budget signed in New York State that passed a law saying that there would be a 2.5-year look back for home care Medicaid. That, because of COVID and other reasons, has not been approved by the federal government. Therefore, it is not law. Even though it's on the books and the records in New York for law, as a law, it is not implemented by the Department of Health because we don't have federal approval from CMS, Center for Medicare and Medicaid Services, and it would have to be implemented in New York. So we currently have no look back for home care Medicaid. The other issue I want to point out is that financial eligibility for home care Medicaid is step one, but the second part is actually finding the care and receiving the care. And when we get to more remote areas, certainly Shelter Island falling into that category, but I would really count most parts of the East End of Long Island in this category, there can be a problem finding a caregiver that has the necessary transportation to get to the job and fill the hours. So I always caution people, if you are in a more remote area, that it might be hard to implement this and you would want a lot of lead time in terms of getting yourself on services and getting the care in place, to understand that it could take a little while to find an appropriate home health aide who can actually fill the hours. I'm going to pause again there and see if there's any questions on that topic.
Eleni has a question, so okay, you should be able to ask your question.
Okay, I think I unmuted, so you hear there are no houses and few people, I think, on the East End that would qualify for Medicaid. So what you hear over and over again is, well, you've got a house, a normal house, a $2 million house. And I don't know, a $500,000 Roth account or, a couple $100,000. You're not qualifying. Is it that you qualified first, or is that you put your properties and your assets in an IRLT in order not to qualify? I mean, in order not to disqualify. Does that make any sense? Because it's like, which came first, the chicken or the egg?
Yep. So, yep, I understand your question. So a few things. One is, this is estate planning that you would do in advance of applying for Medicaid. So this is the egg that came before the chicken. I don't know how to answer that. But yeah, so this is first. So basically your first step would be to put your home into the irrevocable Medicaid asset protection trust so that it was protected for when you apply for eligibility. In terms of an IRA, even with a Roth, the way Suffolk County will treat that is that as long retirement accounts are not counted as an asset for Medicaid eligibility, as long as you're receiving distributions. And even though a Roth by the IRS standards does not require a minimum distribution like a traditional IRA does, under the Medicaid world, if you are taking distributions from a Roth, similar to how you would take them under the traditional IRA, then that is a protected asset for Medicaid eligibility as well. And the distributions are just seen as a stream of income.
Disqualifying you?
Qualifying you.
Qualifying.
Yeah. So if what you own is your house and an IRA, traditional or a Roth, then if those are your two main assets, then the house can go in the trust and the retirement account is protected as long as distributions are coming out of it. They call it in payout status.
I see. Okay. But again, and I think I might be finally getting this after like 2 years of just, trying to figure out what comes first. If you didn't put your property in an IRLT, that's another question. Actually, can the IRLT, I don't know what the term is, initiate, let's say, upon your death?
So no, you have to actually create the trust, sign a deed to put the house into the trust. And then what will happen upon your death is that the terms of the trust will say what should happen with the house. Are you saying it be sold and distributed? Are you saying it goes equal to your kids and they decide? You would, just like in a will, you would say what would happen at your death. But you have to create the trust while you're alive and then sign a deed transferring the home into it.
Right, but then is it true that you would not be restricted if you have, some piece in there that says, I mean, I have relatives who claim to have done this, so I'm not just dreaming it up. That it's not going to initiate or fall into place or become whatever until they pass. So they're not restricted. They haven't given anything away, apparently, until their death. And then they've written everything in there. Yes, it goes to the second wife or it goes to the kids.
I would have to see what they have. I'm not sure, but if you're talking about a Medicaid asset protection trust, you would have to fund it while you were alive, put assets in it while you were alive. That would be the whole purpose of doing it. So it wouldn't make sense.
No, it would be. It's put together when you're alive. The whole thing is put together when you're alive.
Yep.
Yeah. I don't know.
Okay.
Yeah. I don't know.
All right. Okay,
Sorry.
great. No, all good. Thank you. I know we just have a few more questions that popped in, so we're gonna go over there. Okay. Vivian asks, is it wise to have two children both as trustees and beneficiaries of a revocable trust, or does that create a conflict? And then also, what about using co-executors for a will? Is that a problem?
Yeah. So kind of the same answer for both. It depends, right? So I always say to people, you know your kids better than I do, right? So do they have conflicts? So some people would say, and this is very person specific, and this is what we have to discuss when we're looking to draft these documents is, do they get along? Now, that doesn't necessarily mean one answer or the other, but that's one question. The other question is, if you name one, is the other going to be inherently suspicious or angry, and will it create a conflict, right? So some people say, name them both for everything, and they can figure it out between them. They get along well enough. But the point is that we want full transparency, and I don't want anyone to think that the other's wielding control. And then some people have children where one's in finance and one's an artist, and it's very clear who they would want to be in charge of these types of things. And the child who's an artist says, that's really not my thing, so I wouldn't want to get involved. So I would say maybe it could create conflict, but you really have to think about what's going to work in your situation. You want to be careful that you're not creating a situation where there's a deadlock and nothing happens, right? Because then the house falls into disarray. No one's paying the taxes because they can't figure this out. So it's really going to depend on the dynamic of those people in your life and how you think they will act with each other.
Okay.
Questions? I think that was it for the chat.
That's it for the chat. We do have a hand raised. So we'll do this quickly because our time's a little low. So
Yeah.
okay.
I think I'm done with mine. So
Oh,
we're
okay.
Q&A portion now.
Oh, okay, perfect. All right. Eleni, you should be able to speak.
Okay, I think I am. So as far as I understand it, it doesn't really matter what your financial situation is, how wealthy you are, how you wouldn't qualify for Medicaid. Because when you set up an IRLT, you've already protected those assets. It's not about you make too much money, you have too much money, your house is worth too much, whatever. You'd never qualify for Medicaid because you will once you've put everything in an irrevocable trust, thereby qualifying you.
So kind of, I would probably have said it a little differently, but sure, to the extent that you put assets in the irrevocable asset protection trust, they don't count as your asset for Medicaid eligibility purposes. So Medicaid,
Right.
you say I have a trust, you tell them what's in it, but that doesn't get added. So yes, but now that being said, that doesn't because you are restricted on your use of the assets in the trust, that doesn't mean that everybody's just going to go run, put all their assets in a trust. And then, Medicaid says you're allowed to have $32,396 in your name. So
Right.
it's a low amount. So most people who are wealthier are not going to just go put all their assets in a trust, lose all access to it, and live on their 32,000. So it's not necessarily the case that everybody would just, go do this. But to the extent that you put the assets in a trust like this, yes, you would be eligible if you otherwise qualified.
Okay, thank you.
Welcome.
Yeah.
I also want to say that for both the Medicaid Asset Protection Trust as well as the Revocable Trust, for tax purposes, these are tax neutral documents. They're what we call grantor trusts. You are the grantor, you are the creator of the trust, and it's a grantor trust. That's a tax concept. And what it's saying is, so for example, on your home, you still get your star exemption, all your veterans exemptions, any property tax exemptions. If you sell the property while you're alive, you still get your personal exclusion from capital gains tax, $250,000 per person, $500,000 for a couple. Upon your death with both of those types of trusts, you still get what's called a step up in basis for capital gains tax purposes to the date of death value. So these are grantor trusts, and therefore all of those things will apply. For the Medicaid trust, that's all still part of your taxable estate. So again, I'm not often doing tax planning and Medicaid planning with the same client, but anything that goes into this Medicaid trust is counted as yours for estate tax purposes.
And we have a question in the chat that asks, how does a couple create one revocable trust? Does each need to have their own will? Whose social security is used? And does that matter?
Yeah. So very often in our office, we actually create two revocable trusts and we put, let's say you own a house together as spouses, we would put the property one half in each trust, and then they would each use their own social security number. Some, and that's probably a stylistic choice that we make. Other attorneys don't do it that way. If we do a revocable trust, we essentially just pick a social security number. So if you were to do one joint trust, and then we would just pick which spouse's social to use. It's a little more confusing to administer when you do a joint trust, and that's one of the main reasons we don't do that. And with the social security number, you're just picking one. It has no rhyme or reason as to which one it would be. And I should add that depending on what the assets were and if they had the same or different beneficiaries, the hope would be that if you're creating the revocable trust, that you don't have you would have a will, but you would hope that it would not require probate, because one of the main reasons that we're getting rid of, that we're creating that trust is to get rid of the probate.
Okay, and I have someone's hand raised. Vivian, you should be able to ask your question.
Can you hear me?
Yes.
Oh, all this time I thought the problem was on my end. So going back to the revocable trust, because we're in the process of doing this right now, and it's very confusing. If we do something such as what you talk about, the joint of having two wills, we're going to have two wills. If we have two revocable trusts, then does that create any probate problems when one dies?
No, I mean, having a revocable trust should get rid of any probate problems. The key to avoiding probate is to create the trust and then put things in it. So if you create a trust, but then you don't take step 2 of signing the deed to put the house in the trust, going to the bank and moving the account into the trust, if you don't take the step to put things in the trust, it defeats the purpose of creating the trust. So you avoid probate by putting things in the trust and therefore not having it in your individual name.
So your establishment prefers the two wills and then two separate revocable trusts, and dividing the assets in half and putting half in one and half in the other.
Yes.
If you only have a revocable trust in one will and not the other, but these items are in joint, it still can, everything get transferred to the surviving spouse, right?
Yeah, it would depend on how the trust is drafted, but yes. And also, just so you know, when we create trusts, very often, although there are exceptions to this, the wills that we're creating are what are called pour over wills. So they are wills that say, upon my death, if there's anything in my name that has to go to probate my will and then pour this into my trust. But, it's going to depend on the situation. But for the most part, that's the kind of will we create to go along with the trust. Because remember, the goal is not to have to probate the will if you're creating the trust.
Okay, thank you. And also my question about co-executors in a will. So the question is, if an executor determines who is getting what and everything is done properly, if you have a co-executor, is that a conflict of interest, or is it, as you said, simply a matter of do they get along or not get along?
Yeah, it's a matter of relationship between the two individuals. I mean, they're not really deciding what happens. They're mostly just they're carrying out your wishes as stated in the document. But I will point out that if you do have more than one fiduciary, so more than one power of attorney, more than one trustee, more than one executor, we often these days have been telling people that you should give them in the document independent authority to act, because so either or rather than and, because what we're finding is a lot of banks and institutions don't want to get involved with two individuals that must do everything together because they don't want the liability of policing it. So for example, we had an account that trust required that the trustees do everything together. And one of these very large banks sent a check for multiple $1 million closing out the account and said, we don't want to hold that account because we don't want to be responsible for making sure these two people are acting together. So I definitely recommend, if you're going to have more than one person, that you put in there that they can act independently of each other. With
They
them
can.
concurring, so they should agree and run things by each other, but the act of one is good enough. You don't need them both to act. By act, I mean sign or
And you
things.
used the term, you said an independent what? Independent.
What did I just say?
In the
Independent.
way in the beginning, you said, make sure that you put down that they have an independent
Oh, the authority to act independently,
authority. Okay, authority.
as opposed to must act jointly.
Okay. But then doesn't that again create a problem of where one would do one thing and without the consulting of the other?
So it would be that they have to concur, they have to agree, but one can take action. So they're required to talk to each other. But again, this goes back to the relationship. I mean, I would say that if you have two people who are acting together, it would be good if they talked about everything, but then they delegated responsibilities because it's less work on each person. But if they don't get along and it's clear that one's just going to go behind the other's back, then no, I wouldn't name those people to act together.
All right, thank you. I think that made it clearer, authority to act independently, but have to concur that's written in the revocable trust. Okay.
Right.
And in revocable trust, then on the death of one spouse, you said becomes an irrevocable trust?
Well, yeah, when the creator of a trust dies, the trust becomes irrevocable.
Okay. Okay, but then everything's getting transferred over anyway to the surviving spouse. Okay. This is very confusing.
Hopefully we've clarified a few things for you today.
You did. Thank you.
Good.
All right. I know we have like 3 minutes left. Does anyone have any last minute questions for Britt at all? Okay. Oh, let's see.
Me.
Oh, it's you? Okay.
I was pressing the button.
All right, that seems to have brought us to the end. All right, so I mean, as always, thank you so much, Britt, for coming out and talking to us today. We always really appreciate it.
My pleasure. Thanks for having me. Thank you everyone for tuning in. Enjoy the rest of the day.
All right, have a great day, everybody. Yeah, and have a wonderful start to summer.
Yay. All right. Bye.
All right, bye, everyone.